Oh, wow, look at this.
Yeah, it's a very interesting one.
Actually surprised by this.
Me too.
Revenue and profit have absolutely skyrocketed. You're going to be unstoppable. Guys, 3 stocks at or near a 52-week low. SiriusXM Radio, Lumen Technologies, 3M. Now, here's why I want to focus on Sirius and Lumen. Lumen, by the way, is getting kicked off the S&P 500. Guys, here's SiriusXM Radio, all-time high, basically $70 in March of 2000, 23 years ago, $670. It's currently at $3.62. In that time frame, revenue and profit have absolutely skyrocketed. Dozens and dozens and dozens, maybe even more than that, times more revenue and profit. But why is the stock down? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What does that mean? It means whatever's popular is going to go up, whatever's not popular is going to go down. And in the long run, the true value of the business will stick, and that's what will end up happening for the stock price. What was that?
That's incredible.
Isn't that insane?
I've never looked at SiriusXM before. This is incredible.
Absolutely incredible. Now, if you're new to the channel, you've probably seen our other videos where we talk about what's going on in the markets, things like that from a higher level. We also do these individual stocks. And the reason being is when you're understanding that you're buying a stock, that you're buying a piece of a business, you're going to be unstoppable because you're going to realize that if you buy a business that you can reasonably predict what's going to happen in the future, and you buy it for a reasonable price, you're probably going to make good money. That's the key. That's why we made the software. The software was created purely to be able to view these things and then use our stock analyzer tool to make assumptions about the future to tell you if you're overpaying or underpaying for the stock if you bought it today. That's the whole key here. Now, in the short run, don't forget, stocks can go up and down erratically. Every single day, Mr. Market's telling you, I'm either euphoric or I'm not about a stock. And it could last for years. I was just telling an example about 2018. 2018, I said, you know what? I don't think stocks are going to get much crazier than this because the only time they were crazier than this in history was the dot-com bubble. You know what the stock market said to me? Hold more beer. Hold my beer. They went crazier than the dot-com bubble. We got even crazier. We don't think we're anywhere close to the bottom of this market. And we don't think it's going to be a 20% drop. We think it's going to be much more than that. And we have data to prove it. Going back to 1929, based on history, the S&P right now is 60% overvalued based on the stock market GDP. Go ahead, Mo.
So they did revenue this year or last year of $9 billion. What do you think they did in 2000?
It was like 900,000. I looked at it before. Yeah, 2002 was $900,000. Now, they did some mergers, things like that. I don't know which one was XM Radio versus Sirius, all these things. But the bottom line is, guys,
it's amazing.
It's garbage.
Yeah.
And this is what happens. And this isn't the only company like that. Let's pull up Lumen next.
Yeah.
LUMN.
You know, this was another one. I did in a few good minutes on this yesterday, and I was shocked. Based on the past decade.
All-time high, March 19th, 1999. Guys, I was a senior in high school. March 19th, 1999. I was a senior in high school. Oh, by the way, that's basically 24 years ago in a couple of days.
Yep.
And it's gone where? All-time high of $73, and it's currently at $2.53. If I told you after this, guys, look at all the hype stocks you guys love. Not you guys, but the people who are hypesters out there. Because if you're watching this right now, you're probably intelligent enough to realize, wait a second, this isn't making sense out there. What's going on? And you're looking for answers, and that's why you need to subscribe. And if you look at the number of views we have, 75% of those viewers are subscribers to the channel. We're the exact opposite of most YouTubers. That just means that people who subscribe to our channel love our videos and come back and watch it. So subscribe, don't be left out. But this, and then this, euphoria. This is crazy.
It is crazy.
Now, what's happened to Lumen's revenue and profit?
Yeah, it's a good one to look at.
It's been flat for the last, oh wow, look at this.
Yeah, it's a very interesting one.
The revenue has gone, oh, this is very interesting.
And you would think, I was looking at this and I was thinking, well, the fiber industry is growing by leaps and bounds right now. Why is Lumen not doing so?
So look at 2000. They did $1.4 billion in revenue, $230 million in profit.
Yep.
Last year, let's say the last profitable year, they did $20 billion in revenue and $2 billion in profit. And guess what? The stock is down 95% or more, whatever it is. Guys, this just shows in the long run, stocks are a weighing machine, the fundamentals, but you have to pay a reasonable price for the company. That's the key there. You can't just pay whatever, because if I'd gone back to here and told you revenue would be up 10 times, profit would be up, what's the stock going to do? You'd never guess it was $2, 50 cents.
I would think it would be way more than, what is it, $60, $80, whatever it is. I would think way more.
That's the big difference there, guys. And that's what we look at when we look at companies. We sit there and say, okay, what has to happen? That's why the stock analyzer tool is so important. What is going to happen in the future, and what does that mean for the stock price based on profit margin, multiples, et cetera? And you'll see idiots out there assigning 70 PEs to Tesla in the future. Well, guys, that's not reasonable. Historical average for PE is 15 or 16. And the bigger and bigger Tesla gets, the more and more it should be average. And people are still assigning 70 PEs 10 years from now when it's the largest company in the entire world. That makes zero sense. If you want to believe that makes sense, more power to you. We're not the channel for you. Go follow Meet Kevin. Go follow all those hypesters out there. Go follow all the guys that, mark my words, in a few years won't even talk about stocks anymore.
Yep.
They'll find some other thing to latch onto. This is the big thing that we do when it comes to investing. It's about finding the right pitch. And you're going to say no to a lot of things, and that's okay. Find the right one. You know, we were just talking about a banking analyst friend of ours, Silicon Valley Bank. I asked him last night on a call, did you see this happening? He said, no. But what I did see was, there were a lot of red flags. I looked at the company many times, and every single time there were too many red flags for me. Did I think it was going under? No. Did I think there was going to be run the bank? No. But did I sit there and go, they're not hedging their interest rate risk. This is not good. But that's the thing. You didn't need to know, as Howard Marks always says, we didn't need to understand market-backed securities and CDOs in 2006 and 7 to understand that the real estate market was overpriced. We just looked at other data saying this is overpriced. To understand which spark caused the explosion, you don't need to. If you just understand value and you understand the long term and what really drives value, you will do well.
Yeah.
And that's what we're trying to do here. So let's find a more normal company. Let's go to 3M. Ironically, 3M's ticker symbol is MMM. So 3M's all-time high was 2018 at $260, and their 52-week low is 101, which they're at right now.
Yeah.
Okay.
I'd hit it.
So a couple things on 3M. $56 billion market cap, $84 billion enterprise value. That difference is essentially their net debt. Takes the cash, takes the debt. If you bought the entire company with no debt and no cash, you basically pay $85 billion. Okay? So the current PE, 10. Current 5-year PE, 10. Now, enterprise value basic earning is 15. Okay. Profit margin, pretty stable, 16 to 17%. And the return on invested capital, 5 years, very high, 14.5%. I'm actually surprised by that, Mo.
Yeah, me too.
I thought a boring company like this would have a much lower ROIC.
Same.
Now the 1-year ROIC is lower.
Right.
Really high return on equity. Why? Because they have a lot of debt. When you have a lot of debt, you can make a really high return on equity.
Yeah.
All right, so 500-foot view, this is what it's looking
I
like.
don't really love the dividend, but again,
I didn't even look at the dividend.
Very mature company, I get that, but out of their trailing 12-month free cash flow,
Yeah, they're eating up all of it.
yes, they are.
So the dividend yield is 6%, pays out $3.4 billion, and that's what Mo's talking about. The last 12 months, they've made $3.8 billion in free cash flow, so that's a big chunk of their free cash flow. But their 5-year average is $5.3 billion.
Yeah. It
Okay.
Sounds like a bad year.
All right, so it's a high dividend yield company. All right, let's go check out the 8 pillars. Oh, wow. Actually surprised by this.
Me too.
So Mo has his custom pillars up. And for those of you who belong to our software, you can put up to 12 pillars here of your own choosing. There's trillions, literally like 4.2 trillion different variations you can do. But my 8 pillars I stick with. The only X is a 5-year cash flow is down. Yep. You want to talk about it a little bit more, Mo, while I look at the cash flow?
Same on my pillars. You could. The big thing for me, and guys, if you haven't used this tool yet, I implore you to use it. Go to Tools, drop down Pillar Screener. I have a little bit more stringency on the ROIC. So you can see,
yeah, I
made it 12. So you can make it 15, you can make it 6, you can make whatever you want to make it. PE, I raised it a little bit, 25 instead of 22.5. So the customization is truly endless. I mean, you're not going to live on lifetimes to be able to customize as much as you can on that Pillar Screener.
So Mo, their free cash flow is the only X we have. But look at this. Their free cash flow last year was the lowest they've had in the last 10 years.
Exactly. So I have a feeling that it's going to bump right back up.
So I'm even trying to look above to see what caused it.
See what changed it?
I mean, the change in working capital.
It's not significant.
Yeah, it's not significant. What's the net income? It's about the same. What really dropped? Deferred taxes. That was a big drop. Let's see here. Other
non-cash items changed.
Changes in inventory. No, that wasn't. I mean, maybe it's just a bunch of small things. All right.
This is the thing, if you got seriously interested in here, you could go in the 10K and start digging.
Yeah. And guys, we have courses that are going to be available on our channel, and it's free to all of our users who sign up for the software. Courses that'll teach you about every single financial statement and so many other things. Our plan is in the next few years to come out with 50 plus courses. Again, you can buy them individually, buy them a package, or if you belong to our community for $1 a day, you get the entire community, all the software, everything, all the courses, all included as part of the package. So $1 per day, everythingmoney.com. Check it out. Let's go to the analyst estimates. Oh, they're looking for growth in EPS. So their earnings, now here's the interesting part. This is where the high return on invested capital matters. Look at their earnings per share growing. It's about a 50%, 45% increase in the next 3 or 4 years. But look at the revenue growth.
A lot less.
Yeah. Why? When you have a high return on invested capital, that ROIC, you have to It allows you to invest less money to get a growth in earnings. That's the reason you want a high return on invested capital. Invest less money, get more earnings. That's why it's good compared to another company that might have a 10% ROIC. Now, Mo changed his metric to a 12%, was it?
12%.
I like that. But I'm going to keep ours at 9. Actually, I'm going to change ours probably to 10%.
And that's the great thing. Like if you, one day you're feeling you want to be a little bit more aggressive, go for it. You know, you can change whenever you want.
Yeah. All right. Now remember, guys, with analysts, don't sit there and going, oh, the analysts say this. Analysts are wrong all the time.
Analysts just a week ago were telling you to go buy Silicon Valley Bank.
2 weeks ago, not a single analyst had a sell rating on Silicon Valley Bank. Not a single one.
So that's analysts for you. So take it with a grain of salt. Use some guidance there, but take it with a grain of salt.
All right. Now, stock analyzer tool.
Okay.
Guys, I'm going to do a 20-year analysis. 3M is going to be here for a long time. Those Post-it notes are very, very popular.
Yes, they are. I love them.
High margin business. Mo's going to do a 10-year analysis. We're going to pause the video real quick. That way we can input our assumptions and then we'll walk through them and explain to you what we're doing. But remember, this doesn't include the balance sheet. You have to make sure you like the balance sheet first. And again, we have a course we just completed the other day on balance sheets that's coming out in the next few weeks.
And when we say that, it's line by line going through the balance sheet, making you understand each line.
Yep. All right, so we're going to do our assumptions right now. All right, guys, so we both made our assumptions. On my 20-year assumptions, remember, Mo's doing a 10-year analysis, I'm doing 20. You can do 1 to 20 years, doesn't matter. Revenue growth, I did 3, 5, and 7.
Oh, I did 1, 2, and 3.
Okay, remember, here's the reason why I did 3 minimum. I just think inflation and GDP growth. 5 is probably what a big company like that should do. And then 7, if they kind of kill it a little bit. Profit margin.
I did 16, 16 and a half, and 17, just because it's been so consistent around there.
Very consistent. I did 14, 16, 18. I actually started with 16, 16, 16. I'm like, you know what? Let me just be more conservative.
Yeah.
Free cash flow margin.
16, 16 and a half, and 17.
I did 15, 16, 17.
Okay.
PE.
14, 15, 16.
That's exactly what I did. Same with price of free cash flow. Because guys, high return on invested capital, good, strong company. It's going to be around for a long time, as long as their balance sheet's okay.
Right.
Did I return?
I did 10, 11, and 12 because I did such a low revenue.
I did 10, 12, and 14.
All right.
Now, guys, a couple things before we hit the analyze button. 1, the debt level is concerning for me. I want to make sure I understand those debt levels. If all of a sudden, what are their debts? What's the average interest rates? When's the maturity? If they were to all of a sudden have debt rates go up 2%, how does that affect their bottom line? Those are things that do matter. Okay? Because right now, the last 10 years have been a downward interest rate environment. Yep. So they've been able to do pretty good in the profit margin. That's a big reason why I changed this profit margin. Good point. Okay? Now, hit the analyze button. I'm actually surprised by this. The stock's currently at 102. My numbers, a low price of 125 to 135, high price of 170, mid price of 150. Mo?
I have 123 on the low side, 141 on the high side, middle ground 132. My watch list is 100, but I don't know. My watch is 100 based on these numbers, not based on my research on that debt.
So guys, I'm adding it to my watch list below 100, which is almost there. But the key here is go do more research on this company. It looks like it's pretty interesting. Thank you very much.